Hello to everyone. I hope that at least you can hear me. Okay, great. So you can hear me. There's some problem with my laptop Zoom. It just doesn't respond. I'm afraid I have to restart the conference because it just doesn't respond. So we are now 23. So we're at 23. Shall we start or shall we wait for anybody else? So do you know about any of your mates who asked to wait for him or for her just like a couple of minutes? So if you know about someone who's in a hurry, could you please type in chat? Okay, I don't have any wait for my messages either, so I think we can start. Yeah, sure. So first of all, regarding your previous home task, your grades are not zero. However, in system is that it might happen that you have already checked your grade and your grade's like zero. No, I would like to have a look at your calcs, your logic, and I will grade your home task during this week before Saturday. So, and I'm happy that most of you has already prepared this test, because our today's material is mostly based on what we have studied this Saturday. So today we're going to talk about hedging strategies using futures. So first of all, let's talk about types of hedges that can be constructed with the use of futures. So first of all, we can have short hedge. Short hedge is a construction that is built out of a long asset plus short hedge. Long an asset, it means that you have an asset, you have a stock, or you have a commodity or something. Short hedge, it means that you short any futures or forex contract. Sure, in case I didn't fill calcs, may I send you? Yeah, you can, because it's very important for you and for me to understand that your calcs are correct. I mean, that's just not just a number. I want to know that you entirely understand what you did. So the short hedge locks the price of an asset that is owned or will be owned. That's a typical producer's hedge. We call a long hedge a construction that is built out of a short asset and long hedge. Short asset means you owe a stock or you owe a commodity. Long hedge means that you have a futures contract, you long a futures contract. So if you don't have an asset, you owe an asset, and you have a contract, and this contract allows you to sell an asset you don't have. This contract locks the price of an asset that has to be purchased. So while the first hedge is an instrument to hedge any factory need or like oil refinery need. So I need an asset. I have oil, I have coal, I have sugar, I have anything else. And I'd like, so I'm long an asset and I'd like to lock a price. And I'd like to sell what I produce at fixed price. If I'm involved into any second step production and I purchase raw materials, or I'm in railway companies, air carriers, they purchase energy, they purchase oil, and they are likely to be involved into long hedge, into a construction, what is called a long hedge. And finally, there might be a partially offsetting combination that is used to balance a portfolio. This hedge is a typical way of managing a position for any fund or any portfolio manager, when you have various assets, you are long an asset, you short an asset, and so on. So you are involved into actively managed portfolio management, and you are very likely to be involved into short hedge, long hedge, or their combination, like described in this part. So what is important about all these positions? While I have mentioned just very basic logic, it's very important to know an exact number of futures contracts that can be used to hedge your position. So how many futures contracts should an oil refinery or sugar producer or a hedge fund manager purchase to balance his portfolio? So as far as you remember from our previous lecture, our futures contracts are cleared daily and they are settled daily. And that's why having futures on a company balance can affect their profits or losses, their P&L. Having forward contracts on a balance is sensitive to financial institutions who are subject to financial regulation, because forward contracts, long forward contracts may be subject to additional reserve requirements. So you have a forward contract, and while you are having a forward contract, as a financial institution, you are required to have a certain amount of money reserved on your account. So you are not allowed to use this money. You have to keep them. That's the Basel, the second Basel and the third Basel requirements. These creating additional reserve requirements. So what is important? While your calculations may lead to a very specific amount of money that should be hedged with futures, or a specific number of futures, like 4.3 futures contracts, we should realize that futures contracts are contracts. So you are not allowed to purchase like 1.6 futures contracts. You can purchase one futures contract or two contracts. So, and we will talk about futures contract mechanics and various types of futures that are available on global exchange. So let's go forward. If you have any I've got a question about some examples with numbers. We will have lots of examples during this lecture in screenshots. And if you feel that these examples are not enough, after the lecture, I can show you some links that's, and you can have a look at futures that I traded on, like ICE or somewhere else. So what type of risk is hedged by a futures contract? As far as you know, you don't have any course in risk management or something like this. So there are different types of risk, like credit risk, market risk, interest rate risk. There might be a liquidity risk. So these types of risk are out of the scope of this course, But I strongly recommend you to put down these words, these notions, and have a look at these types of risk, just to be familiar with terms that are used by risk managers or portfolio managers. So credit risk, market risk, liquidity risk. And here we are going to talk about basis risk. So first of all, futures are traded. Futures are traded on exchange, and these contracts are issued by an exchange, and their specifications are determined by an exchange. What does it mean? It means that if you like to hedge a specific stock or a specific commodity, it is very often that you hedge your specific asset with a proxy asset. So you require like a specific fuel, but mostly we don't have futures on fuel that's used by tankers or fuel that's used by cars or by airplanes and so on. So there are various types of different fuel. And mostly these asset price is hedged with oil futures. If you produce something out of a specific type of sugar, their specific type of sugar is not covered by futures. They'll have just sugar futures, regardless of what particular type of sugar your plant or your factory imports or purchase. That's the first point. So when you hedge your business with futures contracts, you use a proxy asset. The second point is that your operations have their specific schedule. You have your specific date of delivery, your specific date of any trading and so on. But futures are available on the majority of dates. But in fact, you don't have any type of futures that expires at any selected date. So it might be a difference between your timing and dates that are provided by existing futures contracts. So it might happen that you close your position before you make your operation. Like you close your futures contract on Monday. They don't expire on Monday, they mostly expire on Wednesday and Friday. So you close your position on Friday, but you have to make an order or a delivery or whatever on Monday or on Tuesday. So in this case, you have a couple of days that are not covered. Your position is not hedged. So the basis is defined as the difference. That's the basis. That's how the basis is defined. So the basis is defined as difference between a spot price of asset and futures price of contract used. So the spot price is a particular equity, a particular commodity, a particular asset that you'd like to hedge, price of what you'd like to hedge with a futures contract. And futures price is what is stated in a futures contract. So basis risk is a potential risk that arises from different mismatches in a hedged position. So first of all, this asset type, you use a proxy, you don't have futures contract, for any type of asset. Dates, futures expire on like Friday. Your operational date is Tuesday. And these two things, timing and asset, gives rise to basis risk. So if you had an asset with a futures that is issued on this particular asset, the basis risk in fact should be 0 if you don't have any mismatch in dates. So there might be two different cases. You can have positive basis, you can have negative basis. Market practice tells us that high interest rate currencies and commodities, they tend to have positive basis, while low interest rate rates, gold, silver, they tend to have negative basis. What does it mean they tend to? If we talk about commodities, let's consider commodities and let's examine what a basis risk is on any commodity example. Positive basis. Look, here's the definition of basis. Spot price of an asset must be a little bit bigger than the futures price of the contract. Spot price is higher than the future price. Spot price is higher. It means that market players would like to have these assets right here and right now. So it means that having asset here is better than having a contract. It means that these type of assets has a high convenience yield. So it's very convenient to have this asset right here and right now. And that's why the basis risk, the basis is positive. Okay, the basis is positive. Does it mean that if the basis is positive, we are not, our position is not facing any basis risk? No. In fact, regardless on basis sign, whether it is positive or negative, our position, if we don't have the same asset, is always a subject to basis risk. Because it might happen that spot prices and futures prices might just differ, and you expect to have positive basis, but in fact you experience negative basis, and that's how basis risk arises. The same thing to negative basis. So basically, to make it clear, basis is positive for those assets, for assets with high convenience yield, assets that market players would like to have, physically have. Basis is negative for those assets that is not generating any return right here, right now. Like oil is used in production, and what is produced out of oil generates profit, and that's why it's important to have oil in oil refinery. So that's the key idea, how you can estimate a sign of basis. So I'm looking at chat. If I don't see any questions, but if you have any, don't hesitate to type or to ask aloud. So we have two notions that are linked to bases: strengthening of the bases and weakening of the bases. These two terms are used quite often in some reports and financial news, like strengthening of the bases on oil futures. Mostly they don't say like oil futures, as we have lots of different types of oil. In financial news, they often use a type of oil, like sweet crude oil or Brent oil. And by the way, does anybody know why do we call Texas oil sweet oil? Do you have any guesses? Sweet oil.
Excuse me, what and what oil?
Sweet oil. Why do reporters call oil, Texas oil, a sweet oil? Why do they use this term? Any ideas?
Sweet or sweet?
Sweet, like candy.
I don't know.
Okay, I've never tried it myself, but people say that in fact oil is a bit sweet. I mean, there is a person who tasted oil, and this person said that this particular oil blend was sweet. Okay, so I've got a good question about, so I'll read the question aloud. What is futures price of contract? We know that futures price is calculated as spot price multiplied by percent factor. And in that case, futures price is higher than the spot price. So look, we have a traded asset, and we have its price. And we have a futures contract on a different asset, a proxy asset, because we don't have this particular asset that we'd like to hedge. Futures on this particular asset just don't exist. So we don't have these futures contracts. So we pick a futures contract on an asset that has a very high level of correlation to an asset which price we'd like to hedge. So for example, any type of fuel, I like to hedge my future purchase of fuel, because I'm a CFO, or I'm a treasurer at the company that business is transportation. So I'd like to hedge fuel prices, but I don't have futures on fuel. They don't exist. And I have to purchase futures on Brent or another type of oil. And this gives rise to basis risk. Spot price of asset to be hedged, and futures price of contract used. I don't say that that's the same asset. This is asset one, and the futures covers asset number two. Asset number 1 and asset number 2 are highly correlated, but they are different. They're not identical. Mostly when you in risk management or when traders hedge their positions, we always use proxy assets because, for example, I had to deal with Russian corporations, and I had to derive something from their CDS prices. That's perfect, but I work with lots of companies while we just don't have CDS on like a small bank. So we don't have like CDS on, for example, I don't know, Euro Bank, any just an imaginative example, or we don't have a CDS on baking factory. They're not traded, they're not issued. The same with futures. They're not traded, they're not issued. But we have to hedge our portfolio somehow, and we use like combinations of something that looks a little bit similar to what we'd like to have. So we use a term. So did I provide you an understandable answer? Okay. So when we use the term strengthening of the basis, what does it mean, strengthening of the basis? It means that the spot price increases by more than the futures price. A shortage of an asset, the spot price increases. Everyone would like to have these assets right here, right now. And these demand most these asset price up, increases. As for the futures price, for example, market believes that this shortage in future will be liquidated, like there won't be any shortage in future, so futures prices are not affected by these like temporary case. For example, a fire on an oil refinery, or a case with unexpected cold weather. So we expected mild winter, and we believe that the winter gonna be mild, but in this particular week, temperatures are below zero, significantly below zero, and everyone needs heating, and that's why energy spot prices are driven up by this temporary demand, and that's why spot prices increase. So what does it mean? The spot prices increase. We will talk about this later in the second slide. We're just moving from slide to slide with making short steps. So when you hear strengthening of the basis, it means that there is a sort of a shortage of an asset. Everyone needs these assets today, and they don't think about having these assets tomorrow. What about weakening of the basis? So nobody feels a shortage today, but market participants believe that in a month time or in 3 month time, there's gonna be a shortage of these assets. So futures price increases by more than the spot price. A very cold winter is predicted. But now autumn is quite hot. So we don't need any energy right now because storing energy is costly. And there are capacity that energy, we cannot store more energy than we can. I mean, storing energy means electrical systems for energy storing, and their capacity is limited. So autumn is hot. We don't need heating right now, but we believe that winter gonna be quite cold. We can't store energy, and we like to purchase it in 1 month or in 3 month time. And our demand in future drives futures price up. So a postponed demand drives the basis, shortage drives basis, strengthening is shortage now, weakening is expected shortage. Hope that this is clear. So in these things, they gave rise to some hedging problems, because even when you believe your hedge is almost perfect, you can face this weakening of the basis when futures price increases and marginal requirements drain your accounts, drain your trading account. So it's a little bit that might affect your trading P&L or something. So weakening of the basis can affect traders' P&L or can give additional work to risk managers. That's how it works. So finally, basis risk of an imperfect hedge. So we use proxy commodity to hedge prices on a particular product. We have location basis risk. If I need oil or if I need fuel and futures, oil futures are not the same. I mean, if I need oil to be delivered to my oil refinery, it will take some time to deliver this oil. And futures with physical delivery, they have different locations. So if my refinery is located in the Netherlands, I would like to have a futures with physical delivery in the Netherlands, right? And I wouldn't be satisfied with a futures contract with physical delivery somewhere in Norway or the US. And in the Netherlands, there is a Maasvlakte, a very big industrial zone. A new one, you can look first, you can search for some images, a huge 40 or now probably 50 kilometers long area with oil tankers, various refineries and storages. It's really impressive. And I do believe that points like this one are really dangerous for nature, for ecosystem, but it's a very impressive thing. If you ever travel to the Netherlands, just visit this Maasvlakte. It's very impressive, like 40 kilometers of refineries, storages, tankers. It's really impressive. So there are different locations. And if you need a physical delivery of the contract, that gives rise to location basis risk. And finally, a calendar basis risk, what I've mentioned at the beginning of the lecture is that your operations and futures expiration date may differ. So I hope you don't have any questions. Well, when our position is small, and if we're just hedging a part of our operations, a tiny part, basis risk cannot give rise to big problems. But if you have big operational processes, huge amounts of money hedged with proxy futures, that might be really risky. So we have discussed the basis risk, a little bit at the theoretical part, and now we are going to talk about minimum variance hedge ratio. So do you remember what variance is? I hope you do. So if you don't, you can just take your cell phone and Google for what is variance. Sorry? Right, sigma squared. So sigma squared, or for those who studied math in Russian, you can Google for dispersia и стандартное отклонение. For those who studied math in English, just look what variance is if you have got it. So what is a hedge ratio? That's a very simple term. It's the ratio of exposure to a hedging instrument to the value of the hedge asset. Exposure to hedging instrument, that's a numerator. The value of the hedge asset, it's a denominator. It's a ratio expressed in percent value. And it means if the position is fully hedged or a position is not hedged at all. 100% hedge ratio means that we have fully hedged our position. 0, the position is not hedged at all. So calculating hedge ratio is what we're going to do during the part of the lecture. So the hedge ratio is not a constant. So as our asset value changed, or a hedged instrument or hedging instrument's value changed, the hedge ratio changed. So it's impossible to hedge once and forget with your position. You have to rebalance your hedge. So it is possible to fully hedge your position. A fully hedged position, a perfect hedge, generates a risk-free rate. So in fact, we have transaction costs, we have some maintenance costs, because when we post margin, we have a profit forgone because we don't earn any interest on margin. So if we fully hedge an asset with futures contracts, we'll get a rate that's less than risk-free rate due to transaction costs and margin and profit forgone. So if we don't hedge our position, we face market risk. In some cases, bearing significant market risk is too risky for a corporation, for a non-financial, and even for a financial institution. So it's very important to calculate an optimal hedge ratio. And optimal hedge ratio is called a minimum variance hedge ratio because of an equation that gives rise to this optimal hedge ratio, to this ratio. So minimum variance hedge ratio tells us to what percentage of our assets or liability exposure should we hedge. Let's have a look at some formulas. So we denote with delta S change in the spot price of an asset. We denote with delta F change in futures price. Don't forget that spot price is our asset price, and futures price is price of a futures contract on a proxy asset, another asset. We're not talking about, we don't discuss basis risk here. Whether we have it or we don't have it, these particular part of our lecture, like deriving minimum variance hedge ratio, is not sensitive to basis risk, whether we face it or not. So we denote with N sub F and N sub S sizes of positions in futures and in asset. Sigma S is a standard deviation of delta S. Sigma sub F is a standard deviation of delta F. And rho is a coefficient of correlation between delta S and delta F. For those of you who don't remember what coefficient of correlation is, so you can have a look at it. But it's a very basic notion. I hope that is, even if you don't remember, this notion is intuitively understandable. Yeah, we talked about two traded assets, an asset and a futures contract, and that's why coefficient of correlation is a number. If we talk about various assets, in fact, there's a correlation matrix. But we are going to discuss matrices during the course, but in fact, this is a simple case of correlation. So in fact, correlation coefficient is not a coefficient, it's a matrix. So we define a hedge ratio as number of units of asset covered by number of futures contracts. So how many futures contracts should we purchase to hedge this particular amount of asset? First of all, we define total proceeds from the sale of the position. So we have S sub 2. That's a final price of the asset. That's the final price of the asset. We sell S units of asset, S units of asset at price S sub T, a final price, minus delta F. What's delta F? The difference. That's the final price of our futures contract, And that's the initial price. We purchased our futures contracts at price F sub 1. We sold it at F sub 2. The difference between these two prices, delta F, multiplied by number of futures contracts, that's what we that's what we pay, and that's what we earn from our position. Does anybody has a question to this sign, Y minus, where it's clear? Not clear, and that's it. So okay, let's go back to the first slide. I have an asset, right? I have an asset. That's what we started with. That's an asset. I have it. So let's go to the first slide. Long asset. That's why short hedge. If I have one asset, one unit of anything, I'd like to sell it, right? Or I'm sensitive to its price. And I'd like to fix its price or fix a part of its price to hedge my position from a price drop of an asset. Should I sell futures or should I buy futures? Or in other words, if I'd like to fix this price, should I purchase a contract that allows me to buy an asset or a contract that allows me to sell the asset? Right. If I have an asset and I like to fix its price, a part of its price, to fix its price somehow, I need a contract that fixes its price in future. I'd like to sell it at 100. And that's why we have short hedge. I don't want to purchase some more of this asset. If I'd like to purchase these assets, long futures. Long futures is a contract that allows me to purchase an asset at a fixed price. I don't want to purchase an asset. I've already purchased it. I have it. I need a contract that I want to sell. I don't want to buy. I want an opposite. So if long futures means purchasing an asset, short futures means selling an asset. I need a contract to sell an asset, and that's why I use futures contract with the minus sign. So somewhere, is that clear? I hope. So, and that's why we have minus. M sub F with plus, something that gives me, that makes me plus an F, I have to purchase it. I have to buy it. Minus an F, I have to sell it. Okay, I'm happy that this is clear because we're not going to talk about stochastic differential calculus. We're not going to go any further than Black-Scholes and ethyl lemma. So we're not going to like price, Phoenix, contracts, and so on. We are talking about very basic things, but I do believe that if any student knows these basic things, if this person would like to, they would study quantity finance and so on. These are very basic things, and that's why for those of you who works probably with derivatives or structured products or something, our course seems a little bit too simple, but I'm trying to bring the entire group knowledge of this area like to a good level. If you'd like to go to a higher level, feel free to ask me for additional books. So, total proceeds of the sale. I have an asset. If I sell it, I'll get this amount of money. And I had an obligation to sell at fixed price, and this obligation generates, if I believe the price increase here, that generates me a loss. Otherwise, if F2 is lower than F1, okay, this part will generate me a profit. But I have, in this case, I probably have a small loss here, and this small profit will just compensate me for this loss. Let's go further. Could you tell me, please? So now it is 7:30, and the break on Monday is at what time? $7:40. 7:50. Okay, thank you. Okay. So here are total proceeds from the sale of our position. We do some very simple things. Do you remember this? H, hedge ratio. So we can use this hedge ratio. We can use it here and express the number of futures contracts with the number of units of assets multiplied by hedge ratio. As we're willing to determine the hedge ratio, that's why we're introducing these H here. So everything is quite simple. I subtract and I add. So this part is 0. There's nothing happened. That what all math equations require, like we'd like to subtract and add something. This, we have this, and this is delta S. So could you just have a look, because I'm not that good at reading formulas. So we make it asset price difference multiplied by number of assets, futures price difference multiplied by number of units of futures expressed as number of assets multiplied by hedge ratio. Is that the same? So what do we have here? We have this. Okay, we have this. Just remember this line and we'll go forward. So why do we use that? We're going to use this to derive the formula. So I'll give a couple of words explaining the logic. What are we going to do? So futures hedging strategy is applied when we'd like to avoid uncertainty about prices. So we'd like to minimize market risk. If we'd like to minimize something, we often, in math, we often use a minimum variance. So the lower is the variance, the lower is uncertainty. That's the idea. That's why we're trying to find the minimum variance. It's an explanation for those of you who don't have a mathematical background. Just the lower is the variance, the lower is uncertainty. For those of you who have mathematical backgrounds, so if total proceeds from the sale of a reposition can be expressed as follows. So once again, this is our total proceeds. By replacing by this add subtract, we expressed our total proceeds like this. So we have our total proceeds expression here, and delta S minus delta F multiplied by H. The minimum variance, delta S, is the difference between initial and resulting asset price. Delta F is the difference between initial and resulting futures price. So these two deltas are price differences. Delta F multiplied by H. Why? Because of this line. It just turned out that it can be expressed as follows. So this part is fixed, right? That's the number of assets and the initial price. And we cannot affect this part. That's what we have. N sub S is what we have. We cannot affect this number of units of asset. And this part, we like to minimize it. We have to find H to minimize these. So, and that's why the minimum variance is defined by these only parts, because the rest is known and observable. This is a variance of portfolio of two assets. This is a very common expression. So you can find this same expression, and you can find how this expression is derived if you search for variance of portfolio, and you will be given an example with a portfolio of two assets. And this is the natural property of variance. Variance of two variables. For those who have mathematical background, you can just find in your memory a variance of two variables, or you can have a look. This is a very typical formula, several lines of explanation. So now we have it like a formula from Wiki. I have two variables. I go to Wikipedia. and I search for variance of two variables. And I use this expression, variance of two variables. Variance of two variables is expressed as follows. That's sigma squared sub s, sigma squared sub f, the first value of the first variable, that's the second variable, and that's the correlation raw of these two variables, and this their sigma sub f, sigma sub s. Why we introduce H? We need to know how many assets, how many units of futures contracts we have to purchase, and we introduce H to be able to express number of futures contracts purchased from number with via number of units of asset purchased. We can introduce any other sign, or we can just keep the ratio, but it's not very convenient because n sub s is known and n sub f is what we're trying to find. Okay, so try to remember what you have studied during the course of mathematical analysis. If you have any function, so now since we have expressed a variance of portfolio, we can treat this as a function. There is something squared, then something is here. Once again, something squared, and something is here. So it just looks like a function. H is a coefficient, it's a number. So it's like x squared plus y squared minus 2 multiplied by x by y. It's like a very simple function, what you have studied during a mathematical analysis course. So you have a function of two variables. If you'd like to find a minima of function of two variables, what should you do? You just find the derivative of this function. If you believe that in our case, we are particularly interested in H. And in this case, so mostly in portfolio analysis, you have this function and you calculate derivatives to treat sigma s or sigma f. In this case, we don't focus on this. And in our case, it's a very simple quadratic function. This is our point of interest, H. How many units should we purchase? As sigma sub s and sigma sub f, it's just market data. S is an asset, a price of an asset, asset volatility, any asset volatility or futures price volatility is available in any market data set from Bloomberg, from anywhere else. So in our particular case, this is what we know. This is what we know. And we know rho is the coefficient of correlation between futures and an asset. This market data as well. So we don't know H. And in this case, that's a very simple quadratic function, parabolic function. And welcome back to school. You have something like x squared minus x. Can you find a minimum of x squared minus x? Sure. This just, you can find like a discriminant, or you can act like a grown-up, like an adult, and find a derivative. Anyway, the result remains the same. The minimum of a function is a point where its first derivative equals to 0. At bottom of we have this is like a parabolic function. It has a bottom. At the bottom, we have that's first derivative equal to 0. That's a condition of a minima of this function. That's very simple. To ensure that this point that's given by this condition, by the first derivative equal to 0 condition, we have to ensure that the second derivative is positive. The second derivative tells us whether 0 tells us that there might be a minima or a maxima, and the second derivative condition tells us whether it is a minima or a maxima in this particular point. So we have a very simple thing. This should be equal to 0. We solve this equation for h, and we derive h, the Hodge ratio, and it can be expressed as follows. A very simple thing. So, Hodge ratio that minimizes the variance of the Hodge's position is defined as follows. Rho is market data, S is market data, volatility is market data, this volatility is market data. So to calculate the Hodge ratio that minimizes the variance of the Hodge's position, we just need to take this market data. Why do we have to recalculate the Hodge ratio during the life of the position? Because this is not a constant. This is not a constant. And during the life of the position, these parameters change. That's why. Here is the function that I was describing in words. And this is the point, this is the variance. On y-axis, we have a variance of the position. And on the x-axis, we have the Hodge ratio. And there is the point where the variance is minimal. So this is like a conclusion. We can consider the optimal Hodge ratio of the slope of the best fit line when delta S is regressed against delta F. Why do we need it? What regression line? What for? We can just take any calculator or Excel or whatever. Why do we need any sort of regression? We often use regression to look for different, in practice, we use linear regression to look for different values. We just regress different values and model different cases. And that's why keeping in mind that it can be applied. The linear regression is always applied to these financial cases. So the optimal number of contracts can be defined as follows. Why do we have QF here? What's the point? QF is the size of one futures contract, because futures contracts are standardized and they are available in particular sizes. You can have, you can search for like VIX or S&P, like S&P futures, and you can see that there are many types of contracts, but their size are limited. So that's the final thing. It's just a flashcard. You might probably keep it. We're not going to use it, just have it. And we're moving to stock index futures hedge, and you'll have a break. And let's see each other in 10 minutes. Or how many minutes is your break? 10, right? Okay. Ten minutes. Okay, thank you.
Excuse me, but we can't hear you.
Could you tell me at what moment did I disappear?
From the beginning.
From the beginning of this slide?
Oh, from the beginning of this lecture.
This? So what about this slide? Did you hear comments?
No.
We didn't hear anything from the start of this lecture.
Okay, thank you. So I hope you just looked at this slide. So we use stock index futures to hedge an equity portfolio, but in fact, index is a good proxy if you have an equity portfolio that nearly tracks an index. If your portfolio differs from an index, index futures is not a good idea to be used as proxy because you face a significant basis risk. I mean, your portfolio is composed of, let's say, 20 equities, and these equities are not those equities that are included into the S&P 500 with high weight. In this case, dynamics of the index might differ from dynamics of your equity portfolio. So, before you decide to hedge an equity portfolio with index futures, you have to determine to what extent your portfolio is covered by index. What's the coefficient of correlation between your portfolio and the index? And futures hedging strategies, if you'd like to hedge an equity portfolio with index futures, this type of hedging involves beta weighting. Beta is the beta that is used in the CAPM model. So we're gonna talk about this approach. This approach allows us to gauge the sensitivity to broader market moves. So if we denote current value of our portfolio with letter P, and if we denote the current value of stocks underlying one futures contract with A, we can, from these expression, this short formula, we can derive a optimal number of contracts that can be used to hedge an equity portfolio with index futures if we believe that our equity portfolio can be hedged with index futures. Like, we believe that our portfolio just tracks the index. And that's the only case when we are allowed to apply this simple formula. So I added a couple of links to the chat. These links lead you to the CME, Chicago Mercantile Exchange, one of the most respected and one of the most popular exchange where futures contracts are traded. So you can have a look at the list of available contracts, their details, their sizes, and dynamics, prices, trading days, hours, and everything. So it might be interesting just to have a look at some real life examples. So what is important about futures? They are pricey. What do I mean by saying pricey? Consider an index. This is not a true price of S&P today, but if index is 1,000, S&P is like 1,000. One SP standard S&P 500 futures contract entitles you to a trade at $250 multiplied by $1,000. It means that if you purchase one futures contract, you have an obligation to trade $250,000. That's one contract. And that's why futures are instruments that are used by institutional investors, by funds and corporations. Individual investors don't often trade these futures. SME introduced smaller contracts, like 20% of a normal contract. So the multiplier is 50. So one trade, 50 multiplied by 1,000 is $50,000 US. So if you'd like to purchase one futures contract, you have to have $50,000 US. If we talk about S&P futures. So, and if you follow these links, you can have a look at other contracts available. So let's consider an example. Consider an investor who has $3,500,000 US invested in S&P 500 on November the 2nd, 2020. 7 days later, on November the 9th, the investor decided to fully hedge his position with SP futures, like normal size futures contracts. So how much SP contracts should be purchased? So we use this simple formula. P, this portfolio. P, 3 million. Can you see the green line? $3,500,000 US invested on November the 2nd, turned into the futures price. That's the futures price on November the 2nd. That's the future, the S&P price on November the 2nd. That's S&P price on November the 9th. So this is my portfolio. This is current value of stocks underlying one futures contract. One futures contract is, there is a multiplier, 250. That's the index value on November the 9th, 3,550.50. We multiply, we receive this number. We put this number here. This is a typo. I mean, there's the $50,000. This mistake. There should be this 5. There should be 0. But we divide this by this, and we get this number. Well, we are not allowed to purchase 3.94, so we have to purchase 4 contracts. And with these 4 contracts, we can fully hedge our position. Well, I think this is one of the simplest things during the course. So all you need is to use an appropriate index price. So if the decision to hedge is taken on November the 9th, the value of underlying stocks should be calculated on November the 9th using equity price on November the 9th. So if you don't have any questions to this simple case, we're gonna move to a more complex case. So in the previous example, we had a portfolio that can be completely hedged by index futures because the investor believed that index was a perfect proxy for his portfolio. But in fact, index is never a perfect proxy for any equity portfolio, because if index is a perfect proxy for your portfolio, what's the reason for building this portfolio? I mean, it is easier to just purchase an index. Tracking an index with a portfolio is a very specific idea. So mostly equity traders have portfolios that are not supposed to track an index. These portfolios are equity portfolios, are mostly linked to equity structured products. I mean, investment banks don't actively trade equities. They're not hedge funds. So if we talk about equity portfolio hedged with futures, it might be an investment bank with equity structured desk, or it might be a hedge fund that actively manages equity portfolio. These two cases, these two cases looks like typical ones. So if you have any questions, type them please, or ask me. So consider the CAPA model, capital asset pricing model. We have expected return expressed via risk-free rate, beta, and expected return of the market. So I hope you do remember this model. If you don't, so please have a look at Vicky or somewhere else. Do you have any big questions regarding the model, or we can just skip it? I hope you don't. So what is the beta? Beta is a slope coefficient, or beta is a measure of how much risk this particular investment adds to a portfolio that mirrors the market. So if I have a market portfolio or index, what portion of risk this additional security can add to my portfolio? If I model excess return in portfolio over the risk-free rate, the beta is the slope of the best fit line obtained when excess return is modeled over risk-free rate. So in simple words, I think that you can use the first line. Yeah.
Да, здравствуйте.
So when beta is equal to 1, the return of the portfolio mirrors the risk and the return of the market. High beta makes high risk. Beta that's lower than 1, that's a risk reduction to the portfolio. That's like a basic info about beta and the Kippen model. I hope you have all these facts with you. So what is a beta hedge? We have a portfolio that doesn't mirror an index. We can calculate beta for the selected investment. We know all these parameters. If we talk about index futures, we use return on index. We have market. If we use index futures, we use return on index. That is calculated as expected, as it market price expected change. This is our portfolio. So consider a very simple example. If S&P value is increased by 5% in 3 months' time, and the dividend yield is 4%, then 3-month return on index is 5% plus 3-month time dividend yield 4%. 4% is a yearly. We have to divide by 4 periods, and thus we have 6% return on index. This is return on index, and here there's a short info about how to calculate return on index. So that's the difference between the percent change in the index plus its dividend yield, calculated for the same period of time. However, market index doesn't pay dividend itself. So consider a simple case. What if a portfolio manager sell the portfolio and reinvest the proceeds at the risk-free rate instead of taking a hedging position in futures? Well, sounds reasonable, right? Okay, so the hedger wants to be exposed to the performance of a portfolio relative to the market. So when there is a certain level of uncertainty about the market, but there is a strong confidence in a particular asset, that these particular assets or these particular assets will outperform the market, we can use this type of hedge to remove the risk from market moves. So once again, if I sell my portfolio, I will get risk-free rate only. That's a nice way, a nice idea. But if I do believe that there is a particular security, in this particular security, this particular asset or several assets in my portfolio gonna outperform the market. And the only thing I'm willing is to eliminate a portion of risk that is linked to the market. Selling portfolio is not a good idea. So I have 5 stocks. I do believe that the first and the second stock can outperform the market. However, I believe that the rest of my portfolio gonna follow the market. I don't like to sell the asset because, for example, I believe that in the long term, all 5 stocks can outperform the market. Or I keep these stocks as part of some other portfolios. I just want to hedge the performance of the remaining parts of my portfolio for a certain period of time. And I will use this hedge with index futures to eliminate risk linked to a part of my portfolio. This example is described, the example is different holding period as explained in this part of the slide. So if I have a portfolio and I like to keep it for a long period, and I believe that in long term, my stocks can outperform the market, or I need these stocks to hedge some structured products, for example. So I don't want to sell these equities. I want to keep them. In this case, if I don't want to sell these instruments, I can purchase futures contracts. If these contracts cover the period I'd like to be hedged for. There is one more argument. There's selling and purchasing that's costly, because if I have a huge position, I will pay broker commission for selling out, and I will have to pay broker commission for buying my position back. And if I sell position and buy it back, I will have to pay double commission. If I purchase futures contract, I will pay commission for purchasing an instrument. So, and the last reason is that selling means eliminating risk, zero risk-free rate, zero risk. But if I don't want to reduce my risk, if I don't want to eliminate my risk, if I'd like to reduce it a little bit, I'd like to manage my equity risk. In this case, selling is not a good idea. So in this case, purchasing futures is better. So this was some reasoning. Why do traders act as described? And here we have an example. So we have S&P, August, November prices, the same portfolio, our risk-free rate, a dividend yield on S&P 500. This is Googleable. So we just need to calculate. We need to calculate this part. And that's why we have dividend yield here, our beta, and details. Investor shorts 3-month futures contracts with 4 months to maturity to hedge the portfolio over 3 months. So how to read this short 3-month futures contracts with 4-month to maturity to hedge the portfolio over 3 months. Okay, so 3-month futures contracts. The life of the contract lasts 3 months. 4 months to maturity. The contract expires in 4 months from now. If it is a 3-month contract, 4 minus 3, it means that this contract starts in 1 month from now. And here is the multiplier. So what can we say about this portfolio on the 1st of August? The current futures price here, the number of futures contracts hedging the portfolio. We just took a price from here, and thus we calculated what we have. This index, here is our index, that's the futures price. We take the futures price, we put it here, 250, that's the multiplier, and we get 4.14 for a contract. Okay. November the 1st. The current, November is in yellow, the current 3-month futures price. The index, we put an index price here, rates, that's the futures price. So this is the futures price, and this is the futures price. Okay, so we purchased futures contracts, we paid this for a futures contract, and here is the price. It looks like we experienced a loss. We have purchased 4 contracts from our position in futures. There's that what we paid, that what we got. 4 contracts, a multiplier, because we need an amount in US dollars. That's the loss from our futures position. Okay, then we had a position in the online, and our position in online that generates value. So look, this is the explanation that we have a return. That's a dividend yield. That's a yearly. We have 3 months, so we have to divide this yearly rate by 3. The index value changed, so we receive this 1.11 because look, it was 3,391, and now it's 3,425. This is 1.11%. That's the price change. So in 3 months' time, an investor earned 1.56. That's the index increase. That's the dividend yield. That's an overall interest. So the risk-free rate, where's the risk-free rate? Here is the risk-free rate. We have 3 months, so we have to divide this number by 3. So we apply the CAPM model. The CAPM model, we use this portfolio return, risk-free rate, beta index, risk-free rate. So here is risk-free rate plus beta 1.5. Here is beta. This is what there's an index return. We get it from here. Minus 0.24, the risk-free rate, and that's an overall, the expected value. That's the expected return, sorry. So that's the expected value of the portfolio is as follows. We experienced loss from our position in futures, $42,000. So this position in asset generated profit, position in futures generated loss. Profit minus loss, that's profit, loss. That's no rule result from our 3-month strategy. So not that bad. So do you have any questions regarding this example? But I tried to make it as detailed as possible, to be honest. That's clear, perfect. So what about individual stock futures hedge? So it's a good exercise, a nice thing, but in fact, it's not very often when you can hedge your asset with an individual stock futures. If you have a look at futures that are traded, so currencies and commodities are subject to individual stock futures hedge. And as for equities, that's quite difficult. And basically, it's equity desk. They don't hedge their positions with futures. If we have an individual stock and we'd like to hedge it with an index futures, we have to understand like to what extent these individual stock can be hedged with an index futures. So we use the beta of the stock. Here it is in this short formula. And we just put beta in front of this ratio. And we use this simple formula to calculate the number of index futures that can be used to hedge a position in a single stock. So, what is important? The hedge protects the position against the risk arising from the market movement. So, if an investor believes that the stock will outperform the market, but isn't sure about the market, it is a good idea. So you take out of your portfolio market performance. You just leave one stock and you take the market out. Who else can use this position? If there is a newly issued stock, and the issuer, an investment bank or SPV or any other issuer, wants to protect themselves. An issuer wants to protect themselves against the market, so they just want to focus on their newly issued security. They don't want to. The security has its particular performance. It can move up, it can move down. There is a certain part of general market behavior. And if I believe that my security, even if its price will go down, it will go down at a lower rate than the market. So the market gonna drop down, and the selected security can just go down a bit. I want to focus on a selected company. I want to leave idiosyncratic risk, and I'd like to eliminate market risk. I can use this futures hedge. So at the same time, this hedge cannot protect you from idiosyncratic risk. Idiosyncratic risk is a risk linked to a particular issuer or a particular company. So that's how it works. I think that's quite clear. So what about rolling the hedge? Rolling the hedge or yielding the yield curve are two strategies that seem very, very convenient and profitable and like cash generating until the curve moves in an opposite direction, until the basis risk arises. And all those traders were involved into rolling the hedge. They are wiped out. What happens? So first of all, consider an expiration date of the hedge as later than the delivery dates of all the futures contracts that are available. So I need like a 3-year hedge. That sounds crazy, but there are no 3 years futures contracts. And I have to purchase a series of futures contracts. So rolling the hedge as a hedging strategy means closing one futures contract and taking the same position in a futures contract with a later delivery date. So the algorithm is described here. But what's the problem? It looks so smooth, but in fact, at time t, you have to close out futures 1 and its price is nearly equal to the spot price, right? Because the futures is traded futures with a delivery date like tomorrow is nearly equal to the spot price. I have to use proceeds from this sale to purchase a futures contract like 3 months, the same asset in 3 months time. This strategy is used to generate money or to roll the hedge until this amount of money is sufficient, is enough to purchase this instrument. If spot price or expiring futures price is lower than expected, you just don't have money to roll your position. There is several stories like Orange County or a recent COVID Brent crisis on Moscow and MOEX, Moscow Stock Exchange, when current prices were lower than expected, and March 19 oil prices, Brent prices were lower than expected, and lots of traders were unable to roll their position. Lots of traders were unable to meet margin requirements to roll their position. And so lots of traders were just wiped out of the market. In fact, this thing happened to Moscow Exchange because delivery dates here differ from delivery dates in the US. And in the US, traders, they just didn't face the same price move. So you can read in details with these guys, and you can read about tiny details that affected, well, futures traders here and didn't affect oil traders in the US. And that's really shocking that no one really paid attention to these delivery dates before. Like Tuesday, Friday, who cares? Well, we all read books. We know that basis risk is a collateral risk as well, but who ever faced this collateral risk today? Well, no one. But, well, we saw it a couple of years ago. We were like lucky to experience an extraordinary thing. So each step in this long rolling game as a source of a basis risk. And this position can be just drained up because of a margin call, or drained up because the lack of funds to maintain it. So if you're interested in this case, you can have a look through various articles, what happened and why US traders were not affected. It's really funny. So herein you can have a look at a detailed or more formalized explanation of what I have told you a couple of minutes ago. So there are two, mostly this term is used for commodities market or FX market, gold, silver, I mean, these types of assets. So we call a market in a backwardation when futures prices compared to spot prices are lower. So what does it mean? Asset right here, right now, is every market participant who trades an asset wants it right here and right now. Asset today is better than asset tomorrow, and spot prices are higher than futures prices. And when market is in backwardation, contracts for further dates are traded at lower prices, and this rolling is possible and can generate profit. So you do nothing, you just purchase a futures contract, you wait, you close the futures contract, you receive additional money because you kept this contract, you take proceeds from a sale of your contract, you purchase a new futures contract, and you keep this just cash generating process until the market turns to a contango state. Like the opposite, what happened in 2019? Futures prices tend to be higher than spot prices. Contracts for future dates were traded at higher prices. So traders were enabled to use proceeds of the sale of assets to roll their position. If you long a contract, if you're just a speculator, that's fine. You can just stop your game. You can avoid purchasing any contract and go on a vacation. But futures traders, they never act this way. They are leveraged this. They're really leveraged. And their leveraged position requires additional margin. And this is the source of these bankruptcies and so on. So if you just long a position, that's not a tragedy. But if you are in a leveraged position, You just have to multiply your annual average, multiplies your profit and multiplies your losses. So that's how things work. I tell about these things with a bit of humor because I don't deal with futures contracts. I think that it's sort of these rolling leveraged futures is a sort of a gambling, and I'm not involved in gambling, and that's why I'm describing this case as a funny one. And my futures traders, I mean, my friends were not as optimistic as I were. So don't trade leveraged futures and don't trade naked leveraged options. We're going to talk about options a bit later. So rolling the hedge forward, that what happened. Short-term futures protection can be used to hedge oil distributing corporation long-term applications from any price moves. They call it as a stack hedging strategy. So when oil prices goes down, hedging deals are unprofitable, while the profitability of deliveries at predetermined price will increase. If prices go up, then the profitability of hedging deals compensates for losses from deliveries at fixed price. So once again, that's a business. Consider an oil distributing corporation or any energy distributing corporation, like Enron, my favorite corporation. So the corporation distributes oil, distributes energy. There is their standard business, their operations, they deliver oil. They purchase oil and deliver, they keep it and they deliver. When oil prices fall, oil is cheap. You don't need to hedge your trades. Cheap oil, but your delivery at fixed price is profitable. If prices go up, then you deliver at fixed price, you lose some money, but you hedge your deals and you get some profit from your hedge. What happens if prices drop down sharply? Losses from hedging happens earlier than profits from future sales. You have futures contracts losses today, and you have delivery 1 month, 3 months or so. And this means lack of funding. And this can lead a corporation to a default. This is a very typical thing this is not what had happened to the Enron, because their story was even more complicated, but this case is very typical. That's small screenshot from the terminal with different tenors, just like for those of you who don't have terminals available, there's futures, there's swaps. That's again a screenshot from the terminal, just to give you a look at how do these things look like. So we're going to talk about these short speeches later. I'm going to get back to these. That's additional material for after classes. We're going to talk about it for those of you who are interested in this. So this is a collection of interest rates flashcards. This is not part of our course, but I think that it's important to understand these things. I hope that you already know these, what is a spot rate, the spot yield curve, and so on. There's the how we express forward rates. Last time I told you about forward rates. So the forward curve, we have discussed it. So spot rate, I lend you $1 today. My interest is 5%. If the term is 1 month, my interest is 5.2%. If the term is like 3 months, my interest in, and so on. This is the term structure of spot rates. Different rates for different terms if you'd like to lend or borrow right now. And the spot yield curve is the curve that is made of these interests. If we are talking about lending in 2 months, in 3 months time, in 5 years from today, and so on, we denote it like this, where X year forward rate, 8 Greek years from today. So that's a bit out of the scope of this course. So we need these interest rates thanks to understand FRA contracts. So I think I will move to FRA contracts, and it will be easier for you to understand why do we talk about interest rates in the course of derivatives. So we call it future rate agreement or forward rate agreement. FRA, it's a forward contract, and it's a forward, it's not exchange traded contract, in which the underlying is an interest rate on a deposit. It involves two counterparties, a fixed payer or a floating receiver. We call this party a long position. Long is the one who pays fixed, receives floating. Why long is the one who pays fixed? Because paying fixed is better than paying floating, is more predictable. Loading is in a more long here is bears less uncertainty. The one who's short pays floating rate, receives fixed rate. So these payments can be linked to LIBOR, to any other market interest rates. So the FRA rate is the fixed payment. So this is the contract. That's how it is structured. We use the same X and Y to specify the contract. So let's consider a simple example. 1/4 FRA contract. It means that the contract has an underlying loan. A term of loan is 4 minus 1 days, 90 days. The contract expires in 30 days and the loan matures in 120 days. So I do believe that you'll have to read the slides several times because this looks very tricky. I do believe that this thing is tricky. I'm sorry. If I could, I wouldn't introduce this strange term to determine a contract, but it was not me who introduced FRA contracts. So let's consider several examples. I'm gonna give you some example. So when we say the price of a FRA contract, the price of what is the price of a FRA contract? It is a price of an instrument that allows to receive floating and pay fixed. So how much would you like to pay for receiving like LIBOR plus some points in turn of fixed rate payment? The answer is the price of a FRA. So the price, and to make it more formal definition, it is the price of the price represents the fixed interest rate at which the long has the obligation to borrow and the short has the obligation to lend for a specified period that is called a term of the underlying hypothetical loan, starting at FRA expiration. I do believe that it sounds extremely tricky. So after you receive slides, and I have already emailed your slides, just read these slides carefully, especially this, starting at FRA expiration. Like what? Starting at expiration? How is that possible that something starts at expiration? It starts at expiration. That's these terms are used because here we have and I gave this example to make you more familiar with these terms. 1/4 expires in 30 days. The first expires in 30 days. What do we have here? The hypothetical underlying loan that matures in 120 days from today. That's 4. So you just need to take this and this. The first, this thing will start after this number of months. And this thing will last this number of months. the second number, this number of month from now. If we take this for -1, we get 3. If today is the 1st of January, this tricky thing starts on the 1st of February and lasts for 3 months, February, March, and April, and it ends at the end of April. And the inception is today. So just read it for a couple of times and you're gonna get used to this terrible logic. So let's consider an example. It's gonna be a little bit easy. 30 days from today, an investor will need to borrow $1 million US for 120 days. In order to hedge the interest rate risk, he takes a long position on a 1/5 FRA contract. Okay. So I need something that will start in 1 month from now because I need to borrow in 1 month from now. And I need this thing to end 5 months from now, 1 month waiting and 4 months just having it. And that's why I have 1 month waiting, 5 months from now, this thing will die. And 5 minus 1, 4 a month or 120 days, that's the product gonna be active. So if today 30-day LIBOR is 5%, 150 days LIBOR is 6%. Why do I have 150? I needed to live for 120 days plus 30 days waiting, 150 days from today LIBOR, that's 1 month waiting and 4 months just paying. What do we have here? Price of FRA contract. Do you remember that the price of FRA contract is the fixed interest rate? Okay, so we have to derive a fixed interest rate from this massive thing. What do? We annualize rate on the 30-day loan. This is the rate. This is 30 days, this rate gonna be active, and 360 days in a year, and we get annualized rate on the 30-day loan. The same way we receive annualized rates on the 150-day loan. We have 2 annualized rates. So the interest rate applicable on our 4-month loan or 120-day loan will be taken 30 days from now. So what do we have? We have to get fixed rate equivalent of this thing. The fixed rate equivalent is the following. This is what we have for 150 days. This is what we have for this 30 days waiting. And that's why I'm pretty sure that for the majority of the group, there's something really difficult to understand even at 9 p.m. To make it easier, now we can get back. So could you please look carefully at these slides, especially this one. I'm pretty sure that you have already started these things. The X-year spot rate, so there's 3-10 interest rates. And if you feel like you don't understand what's going on, before taking a quiz, please send me email with your questions, like what is difficult. But I do believe that you have just to read this thing several times and you will get an understanding of what was going in here. So if we have something for 1 month, and then I have a loan for 1 month, and I have a loan for 4 months then. And at the same time, I have a loan for 5 months from now. This slide demonstrates us that we can have these blocks just to talk about this pricing. This is what I have for 5 months. This is like what I have for 1 month and 4 months. If I multiply this by this 1 month by 4 months, I will get the same rate as for 5 months. And that's why we have here this thing. This is what we have for 5 months. This is what we have for 1 month. This is what we have for 4 months. 1 multiplied by 4 is the same rate as for 5 months. And that's how we get the price of FRA. This is the price of FRA, but we have to get annualized price of FRA. And that's why we make this, this is 4 month rate. We multiply it by year, that's 4 months, and we get an annualized price of FRA, or annualized fixed rate. That is equivalent to this FRA contract. So to value FRA at any time prior to expiration, we have to calculate the new forward rate. We have to calculate the interest savings based on the new or updated market forward rate. Then we have discount for a number of dates. So I think that these words are more difficult to understand than an example in numbers. So you can just use this slide to support this example. So I'm pretty sure that's like self-studying is better for these interest rate details. So there's some interest rate details. So again, you have a look at this example, and I'm gonna comment it because I need your attention, lots of your attention. So consider an example. A selected company wants to deposit 10 million in the bank in 30 days. So in 1 month time, they'd like to deposit 10 million US dollars. it will keep their funds there for 3 months or 90 days at applicable 90-day LIBOR rate. The company wants to protect themselves from a decline in LIBOR rate over the next 30 days. Sounds reasonable, right? So they are quite comfortable with an existing LIBOR rate, but they afraid that in 30 days the LIBOR rate gonna decline and then they gonna lose money. Okay, so they need something that will start in 1 month time, and it will, and this something gonna stop 4 months from now, and that's why they have 1 by 4. 1, it starts in 1 month from now. 4, it ends 4 months from now. 4 minus 1 equals to 3. The life of the contract, the life of this thing, is 3-month period. So the appropriate discount rate for the FRA settlement is 0.45%. After 30 days, 90-day LIBOR is 0.75%. So what's the interest actually paid on the bank deposit? And we have to determine the settlement payment if the FRA is initially priced at 0.7%. We need a FRA that result in cash inflows if 90 days LIBOR falls. I need to protection from rate drop, so I have to take pay floating, receive fixed, right? Because I'm afraid this rate the floating to drop. I want to receive fixed. We call it short FRA. And here we have our calcs. The interest paid at maturity, I receive fixed, okay? And I pay floating, this 0.75, this is 0.45, and this is 0.7, this is fixed, okay? So the interest paid at maturity, I pay floating. That's what I pay. That's the period. That's my payment. The settlement payment is the present value of the interest savings on the underlying hypothetical loan. 0.70 was the fixed rate. Look, the FRA is priced at 0.70. The price of a FRA is a fixed interest rate. So that's what I receive, as I opted for a short FRA, so I wanted to receive fixed, pay floating. That's the difference. That's the payout. That's an overall performance. So the payoff on the FRA contract is this amount. That's the difference. That's what I received. That's what I paid. That's my result. I have my result. Why do I have 0.45 here? The appropriate discount rate for the FRA settlement cash flows. That's right. Okay. I have this. Multiplied by discount factor, and that's what I get. That's the present value. because to bring future value, I have to discount the future value to the present. So since actual LIBOR rate at expiration is greater than the initial price of the FRA, and my position was short, I have a loss. This is my loss. This is the present value of my loss. That's the future value of my loss. So this was a wrong decision. So could you recommend some easier books because the material on slides is difficult for understanding? You can check for books that were given in references. You can use you can just Google for anything, any contract. As for easy books, I'm pretty sure that before taking course in derivatives, you had to study financial markets, you had to study interest rates, loans, and all these compoundings. So I think that the best way of action is to look at those materials that were provided at that time when you study these rates. I mean, interest is a very basic thing, and the target that we don't have interest rates as a target in the derivatives course. That's something that you had to know. That's my favor that I explain you in details these calculations. That's what you must know. I mean, that's receiving a master's degree in finance requires you to understand how to calculate a loan with fixed rates. So there's something that must be something in earlier courses. That's what I think. I mean, derivatives books don't provide info on how to calculate interest on loans. So thank you for your attention. If you are interested in some additional topics and discussions, you are welcome to stay. If you're not interested in an additional assignments, I was happy to see you here. It was interesting to receive your questions. So have a nice evening. So
okay. We discuss something off top.
Yeah. So first of all, I can introduce you some topics. So last year, I offered a group to make short speeches. So if you'd like to investigate some reasons for the collapse, bankruptcies, big stories, big falls, and so on. So last year, I offered the group to make some small speeches on selected companies, like 2 or 3 slides or probably more, to discuss these cases after lectures. So for those who are interested in these topics, and I would be happy to assist you while you're preparing your slides. So I have recommended sources, or I can help you to find some additional links, additional references. And there is a list of, I selected a list of topics. So here is a list of topics. that speak big stories. So you can take any story you'd like to. So the book, The Derivative Debacles, if you look at the camera, I'm showing you the book. So this book is issued in Russian. It's available in bookstores. Or I can just share you the content of the book I have. And I have the majority of these cases printed. So have a look at these cases. Have a look at these references. If you'd like to investigate any, it would be great if you make this a short presentation. My favorite stories are number 14, Metallgesellschaft. That's an old one, but they have everything in this case. And they have, and at Orange County is an interesting one as well. However, they are all quite impressive. So that's my proposal. And if you have any questions, probably any suggestions about our further lectures and or additional parts, you are welcome.
Можно втопные вопросы задавать, эти, которые не касаются темы?
Давайте, у нас тут просто аудитория англоязычная. So, guys, if you'd like to ask a question in Russian and you're afraid that you just won't, you can make some probably mistakes, or you don't know how to explain the difficult case, you can ask in Russian, and I'm gonna translate it to the rest of the audience.
Yes, of course, but I have some personal questions.
Okay, so personal questions. You've got a CV to send. Yeah, you're welcome with your CVs if you'd like to join a quant team.
No, not about question about term, master's paper.
Master's paper? You mean a diploma or?
Yes.
Sure, you are welcome. I gave a list of topics to the study office. So some of topics covers my strategies like VIX straddle, VIX strangle, energy market, and those things. And some topics covers what we do in our quant team, like pricing loans with derivatives, credit valuation adjustment, modeling the interest rates with Black-Karasensky and Hall-White models. But if you have your own idea and you believe that I'm the right person to help you with your master's paper, how do we call it? You're welcome. Okay. And if you opt for difficult topics, linked to Karasensky and XVAs, I think that we will provide you with the data. So it won't be like, go and find data anywhere you can.
Okay, but our study office is not as fast, and we don't know list of your topics.
Oh, I'm sorry. No problem. I'm gonna I'm gonna email list of my topics to the group mail address. Well, if you give me a second, I can send them to chat.
Thank you.
So, as for the rest of the topics, what would you like to include? Probably, I can tell you about the structured products or some barrier, compound, and loopback options, some phonics-like products. So, I mean, I can make it in form of additional reading, some references, some basic things, so you can just go go deeper, having some instructions. So look, there are 4 first topics from my letter to your study office. So for those of you who will have probably troubles with interest rates, I will check books that I have, but I'm pretty sure that I don't have much on interest rates. I suppose there should be something in details in CFA level 1. As far as I remember, they cover this part extensively. So look, I have posted those topics that I have emailed to the study office. If you are interested in any of those topics, you are welcome. If you have any ideas, or you are probably interested in investigating some defaults or modeling defaults, like what should an Orange County risk managers do, or what should they do in any other case, like National Bank of Australia, for example, the fixed options trading. We can, if your study office accept this topic, we can make work on this. So I don't have any ideas. That's all what I wanted to say. Any questions, guys? You don't have any questions? Okay. So I was happy to see you. Have nice evening.